Hey guys, Akil here. Welcome back to the Trading Coach Podcast. Got another video episode for you, so make sure you head over to Spotify or YouTube if you want to watch me in the flesh or whatever podcasting app allows you to watch videos. Got an interesting episode for you today talking about making changes to your trading plan and finding that balance between psychology and profitability, which is always kind of a shifting line, a little bit of a gray area. Now, before we hop in, do me a favor, like, rate, review, whatever you have to do to show your boy some support. I appreciate it in advance. Let's hop in. So, woke up this morning, wiped the crust out my eyes, and woke up to a bombardment of trading questions over on our Tier 1 trading platform, which I love. Many of our traders are based overseas, so by the time I get up, it's about midday, so they're ready to go. And I had a really cool discussion this morning. I want to read you the initial question and then talk a little bit about this. It said, hey, Akil, good morning. I want to drop these ideas and questions in here so I don't forget. So I've been taking trades on a demo account. And one thing I've noticed about my emotions, right, those scary things that cause a lot of traders so much trouble, is that I get a little bit upset after target hits the 382. So target one, pretty much, a 382 is a Fibonacci level. So with this trader and specifically they're trading advanced pattern formations, and our rules for taking targets are different Fibonacci levels, one being the 382. So I get a little bit upset. I've noticed that I get a little bit upset after target hits pretty much target one, and then rallies up, but then stops me out at break even before hitting target two. Now I want to pause right here before we dig deeper into the question, where first and foremost, it is great that this trader is able to understand their emotions. I can tell you how long I've been in this earth, and they're like, Akil, you need to get in touch with your emotions and be more sensitive, right? I'm an athlete, former football player, so I was taught just to bottle everything in and take it out by hitting someone hard on the football field. But as I get older, I understand that knowing yourself is very important. In fact, I had a very busy weekend this past weekend where both of my kids had soccer tournaments, right? They did very good. One, it was one's first tournament ever, the youngest, and the second one, or the oldest, he got second place, which is pretty cool. But we had 2 days of 2 kids at soccer tournaments. Then we did our annual trip to the U.S. Open on Labor Day, got back late, and I came in Monday or Tuesday, and I said, hey, traders, I just need a mental day. I'm taking off. In the past, I would have ran myself into the ground until I got flustered and frustrated and made mistakes in the market or yelled at someone because I'm just flustered and angry. But being able to know myself, being able to reflect and do evaluations, I understood that, hey, I am at that point where I need to woosah, right? Reset before I move on, and had a hell of a trading day actually on that day and the next day as well. So it worked out in my favor, but that wouldn't have happened if I didn't take time to understand myself. So with this trader saying that, hey, I accept and understand that I get mad when this happens, that is brilliant. All right. So I get upset after target hits target one, goes to target two, but then turns around and stops me out for break even instead of achieving second targets. I see all those juicy profits and then poof, it's gone. So I have 2 ideas, right? What if I allocated more of my calculated lot size to target one? So instead of using a lot size of 2, for example, where I take half off at target one and half off at target two, I would shift it a little bit. So I take, the example was 2 lots, 1.5 lots out at target one, and then 0.5 off at target two. So basically 3/4 of my position off at target one, the last quarter off at target two. Another way could be to be used at different level as well and apply the same target taking strategy where I remove at 3 different positions, blah, 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 blah. I'm just trying to maximize profits collected, given the winning cipher is usually guaranteed to hit target one for sure and not the rest. Does this sound good to you? If yes, do I have to back test it? Not sure though, as it's mostly a lot size issue. So where to start? I think the first thing I want to talk about is let's not assume, and I think I saw this somewhere, let's not assume that doing this is more profitable, right? First and foremost, we don't want to assume that making this type of change will be more profitable. We want to let our numbers do the math for us. And this is where it goes back to backtesting. This is why backtesting is so important. It is the gift that keeps on giving, right? Many people, if you don't understand backtesting, it's going through historical data. It's testing your hypothesis, your strategy, and making sure it has a positive expectancy, which basically means making sure it's profitable. But on that journey, you're collecting so much data, not just for what you want the strategy to be at the time, but for most future adjustments that you're going to make. So the easy part about seeing if this is worth it, seeing if it's more profitable, less profitable, whatever it may be, is that we already have the numbers. We already have how many times targets hit target one or trades hit target one. We already have how much trades hit target two. We already have how much target one was in as far as pips, which is the measure that we use to calculate. We already know that for target two. So this is just a plug and play situation where all you have to do is you take your A test, which is your normal backtesting results. You create a B test, which is your new way of doing it, right? 1.5 off at target 1, 0.5 off at target 2, whatever it may be. And then do the math, right? Look at the bottom of the column and here's your profit for A, here's your profit for B. Which one is bigger? That will tell you if the changes that you're making are actually helping or maximizing your profitability or not, right? So years ago, this was in the age of low volatility. It was this weird year. I think it was like 2014 and 2016, where all the volatility was sucked out of the markets. It's good to see it back in right now. I can't tell you how happy I am to see like a 30, 40 pip ATR in an hourly chart, because for a while we were down at like 10, and it's very hard to make money when you're down that low. But there was this year where we had very, very low volatility. And I remember my performance wasn't as good as my expectations. And I do my quarterly review. So I do a review every 3 months. Every 6 months, I'm allowed to change my rules. So I did a review every 3 months. And I said, okay, right, I feel like I'm trading good, right? We have this field and we have the numbers to back it up. I feel like I'm trading good. My results say that I'm trading good as far as like my normal percentages and whatnot, win percentages. But my return on investment isn't where it needs to be. So something's not right. I dug into the numbers and I saw that although I was hitting my normal target ones at a normal rate, I was drastically missing on my target twos. And target twos are the money makers, right? Because if you're trading a half position at target one, a half position at target two, if I only hit target ones, I'm getting a half position. When I lose, guess what? I'm still losing a full position. So it doesn't really balance it out. You can kind of think of in most trading strategies, like your target one will kind of even out with your trades that get stopped out. Then your target twos are what, boom, push you over the edge. So I was at this place where I was trading well, my percentages were good, but I wasn't making the money that I thought I would make. And I dug into it. I did the same exact test that I told you guys, the A/B test, and I noticed that, hey, my target twos were failing me. If I were just to take everything off at target one and not shoot for target twos, I'd be even more profitable than what I was supposed to be. And I made that adjustment that year because of that low volatility to only take target ones on these particular types of trades. And that's something I've stuck to ever since. So, but I wouldn't have known that unless I had that test, unless I can compare data. You just don't want to kind of make this stuff up. You actually need to look at the stats, because the stats will tell us everything that we need to know. They're not blinded by emotions and feelings, right? So it's one thing to look at the profitability factor if that's your goal, but I'm not sure that should always be the goal, right? If you go back to the first sentence, I get upset when target ones are hit. Price goes almost to target two, then comes around and stops me out for break even. I get upset. And upset is an emotion. As a newer trader, it's very hard to handle these emotions. And eventually they lead to mistakes, and mistakes lead to you going broke as a trader, right? So we also have to think about putting ourselves in a position where we're not emotionally vulnerable, right? I say this all the time, right? When I was younger, my dad taught me like, hey, you should not be in these parts of town at these hours, because that's where bad stuff happens. And if you're around when bad stuff happens, you're more likely to be involved in whatever that bad stuff is. So my main way of staying out of trouble as a kid was just not being in places I wasn't supposed to be, right? If friends are going out to Southwest Philly at 12 o'clock at night in the area that I know stuff pops off, let's not go there. And that way, when stuff pops off, I'm not hit or I don't get in trouble and get arrested. And I keep that same philosophy in trading, right? If you can avoid areas or situations that put you in psychological dilemmas, then you don't have those dilemmas and you're more likely to stick to your plan. You're more likely to stick to your plan. The more likely you are to extract your edge, the more likely you are to extract your edge, the more money you make, baby, right? That's the goal. So the one thing we have to realize is that by making this change, am I also helping my psychological state even if it's not profitable? So let's say the trader makes this trade, right? They take the bulk of their position off at target 1. They leave a little bit on for target 2. Part of me thinks that, well, there's 2 ways to go here. Part of me thinks that missing target 2 is not going to hurt as much because there's less of a position size on there. You didn't miss, right? It's not a miss because it never hit, but you didn't miss on as much profit as you would have before. So that makes you feel calmer. You're less upset. You're more likely to follow the plan and not do anything dumb, revenge trading or moving stops and all that fun stuff, right? So even if you have a result where your original way of trading is more profitable than this new way of trading, as long as it's not by a large margin, right? You don't want to go from like a 40% return on investment to like a 10% return on investment. That's just dumb. But if it's somewhere in the same vicinity, it may actually be worth taking a little bit less profit, right? In order to keep a little bit more sanity. I told you guys this a couple podcast episodes ago. I think it was 119 where I talked about my new trading plan when I gave up day trading. I said that day trading was an extra revenue stream that I didn't intend on doing when I first started trading, but it worked and it made me more money. But I stopped day trading to give me more freedom of time. And although I'm making less money because I cut out that revenue stream of day trading, I have more peace, and that's what matters to me. So it's not always about making as much money as possible. Now, one thing you have to pay attention to as well is the other psychological end of things, right? So we're happy when things reverse and because we didn't leave as much money on the table, but what happens when price does hit target 2, right? Are we going to get upset now that, oh man, I took more off at target 1. If I would have taken more off at target 2, I would have made more money? That I don't know. And that's a question that this trader has to ask themselves. Because if that's the case, all we're doing is trading one negative psychological state for another psychological state. And we have to kind of figure that out. And the one thing I tell traders all the time is that there's always a give and a take in trading, right? There is no perfect way to trade. I remember working with a trader years ago who was developing a trend continuation strategy, and we were going back and forth through these strategy labs, talking about it and tweaking it. And we ultimately had a disagreement because I was telling him this, right? Either you're going to be a trend trader that catches the really, 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 really big move and give a lot back when the market retraces, or you're going to have a higher win percentage. You're going to catch smaller moves, but you're going to have to sit and watch that big trend roll on for 600, 1,000 pips every once in a while. Not too often, but every once in a while. And the trader was like, no, Akil, I'ma do both. And I said, no, you're not. He said, yeah, Akil, I'ma do both. Watch me. And I said, okay, I'll watch you. I'll watch you. So I watched. And what do you think happened? Eventually, this trader came back to me and said, it can't be done. I'm like, really? It can't be done. You don't say, right? And he was trying to capture the best of both worlds. He was trying to hold on for the entirety of the big trend, which meant having a looser trail stop. That way he can absorb kind of the ebbs and the flow of the market. But he was also trying to get out at the first sign of danger so that he didn't give any profit back. So he was trailing quicker so he didn't have to give as much back. And it just didn't work. He was always one step behind. So in order, I told that trader, you have to choose. You can't have both. It has to be one or the other. One is going to have these benefits. One is going to have these drawbacks. The other one is going to have these benefits. The other one's going to have these drawbacks. And you just have to make peace with that. And that goes for any type of trading strategy. That goes for any type of trading dilemma or shift that you would make. I would say one more story just on this topic about psychology. And this is just, I say it because it's a cool story I heard before. I don't remember where I read it at. I'm not sure if it was an interview or one of the many books I have over here. But there was a trader that knew himself. So going back to the beginning, we're talking about knowing yourself. And he knew that his biggest psychological trigger was not losing it all. Not losing it all as far as the account, but losing all of his risk on a trade. So if he risked 2% on a trade, he got upset if he lost all 2%. If he lost 1.9%, he wasn't upset because it was just the fact of losing it all that made him mad. So he implemented this strategy where as soon as price action cleared his spread and went into profit, he would take a very minuscule position out. He would take a little bit of profit out. And it wasn't anything that was a game changer, but it was simply because mentally he knew that because I took something out, I can't lose it all. And that was all he needed to do to have the confidence to stay in the rest of the trade and see it out. He no longer made mistakes because he kind of, I guess, I don't know, what is it? He filled that urge or that fear, whatever it may be. So again, the power of psychology is key, and you have to know yourself, and you have to combine that psychological aspect of putting yourself in a position to profit with the actual profit factor from your strategy. I'm done. I'm not done. I got to give you the outro. Before you leave, do me a favor, hit that like button, rate, review if you haven't done so already. Make sure you subscribe to the YouTube channel, right? I do videos each and every week. They're cool. They're technical analysis. It's the stuff that is probably boring, but it's consistent, and I'm true to my message each and every year for the last, I don't know how many years that I've been doing these trading edge videos. So check it out. See if you like it. There's tons on there for you to watch. And of course, I'll see you at the next episode of the Trading Coach Podcast. Until then, play and trade, trade your plan. Take care.